Welcome to the new age. Jerome Powell, chairman of the Federal Reserve Board of Governors, has decided it's time to retire the term transitory in reference to inflation. That's right. Transitory inflation is officially over, so saith Jerome Powell. Now, the interesting thing before I move forward is I want to point out that Jerome Powell has just secured an appointment from Joe Biden to another 4-year term as the chairman of the Fed. And so I should point out that it's possible that part of his dovishness, his extreme dovishness, his never-before-seen dovishness, more dovish than even what's his name? Alan Greenspan. Gosh, what the heck was wrong with my brain? Why couldn't I think of Greenspan's name? And Ben Bernanke. I guess you could say he's probably about as dovish as Janet Yellen. But now that he's secured that second 4-year term, is it possible that now he'll feel a little more emboldened to not be so dovish? Maybe to be a little tougher on inflation? Maybe not be so incredibly accommodative for the stock market? I don't know. It's not something that I necessarily believe, but it's something to consider. And so with that little, caveat out of the way, Powell is not stopping by just saying, okay, inflation isn't transitory. We shouldn't say it's transitory anymore. I believe his exact quote was something to the extent of permanently higher inflation is now, or perpetually, or something like that, is now a greater risk than it used to be. And so this is about as much of an acknowledgement of inflation as we could hope for from a Fed chairman. He's saying it's a problem. He's saying it's not just going to go away. It's not transitory anymore. And if a Fed chairman is talking like this, I think the implication is, well, if the Fed is willing to acknowledge the problem, maybe they're willing to actually do something about the problem, to try and fight it, to try and fight inflation. And this is something that I firmly have said since 2018, late 2018, was not going to happen, that Powell would not do. And as of right now, I still stand by that. Powell has a lot of room to talk. He has a lot of room to manage expectations before he actually has to get to the point where he has to pull the trigger and raise rates. And I think he's never going to do that. I don't think he's ever going to pull the trigger. I think that he might continue to ramp up his rhetoric, which we're clearly seeing him do right now. I mean, this is a major shift in Fed rhetoric to go from transitory is dead, and the taper, we're going to have to speed up the taper. I think, if I remember correctly, the way he phrased it was, the taper will end sooner than expected, which is a nice way of saying that the taper is going to be much more abrupt. It's not going to be this measly, 80 billion a month? Actually, they might not have even tapered that much yet. We might still be way up at 120, because I think the idea was to taper, to taper 10 billion? Yeah, it was tapering. I think they wanted to taper 10 billion every month. Meaning going from 120 billion to 110 billion to 100 billion. Apparently, Powell is saying in the face of non-transitory inflation now, that schedule may get pushed up a bit. And again, the implication of that being that, well, inflation's a problem. We need to hurry up and get through and over with the taper so that we can get on to raising rates, because Powell has said in the past that he does not want to get into a situation where he has to raise rates, which of course I say he'll never do, but Powell says that he could do it. You don't want to get to the point where the Fed is raising rates and still doing QE. So you have to completely finish the taper and end QE before you can even think about raising rates. Now, something interesting, though, if you look at the bond market today, one might think, intuitively, well, gee, Powell is talking about essentially raising rates at some time in the future. That's what Powell's discussing. That's what Powell's kind of implying here, is that, well, inflation is worse than we thought. We're going to have to do something about that. And that's something, the only thing that the Fed can do is raise interest rates. So you would think, well, gee, if you look at the bond market, we would expect to see rising interest rates, wouldn't we? Well, that's the opposite of what you saw. Yields today plunged. And there's a number of ways you could explain that. But it's not, either way, it's not really a big surprise. One way you could interpret this move in the bond market, where again, bond prices were bid up, bond yields, the interest rate being bid down. One way to explain that is just that the bond market does not buy into what the Fed is saying. Either the bond market in aggregate doesn't think that Jerome Powell will raise interest rates. They think that he'll cut interest rates even further, even though they're already at zero. Maybe they think, well, he'll do negative interest rates. That's one way you could interpret this. I don't think that's what they're saying here. That's not how I interpret this, but that is one interpretation that could explain why bond yields are falling when the Fed is basically implying that they're going to raise rates. The second is that the bond market does not think that Powell really has control over interest rates, that they do not buy into the all-powerfulness of the Fed and the Fed chairman. The bond market doesn't think, well, hey, Powell said, essentially is saying that yields have to rise, or that, interest rates have to rise. He's not in charge of us. We set interest rates, he doesn't. And then the third possible interpretation of this move in the bond market is that the bond market understands that Powell's words, his expectations policy, mainly is going to impact the stock market, and it's going to be negative for stocks. What Powell is saying, he's saying, hey, we're going to give the stock market less of that easy money that they like, because for whatever reason the stock market likes QE. I've tried, but I don't see the direct correlation between why QE makes the stock market go up. But people in the stock market with a lot of money like QE, and so when there's a lot of QE, people go out and they buy stocks. And so it seems like QE has a strong psychological effect on the stock market. And so if Powell's talking about tapering faster than initially thought, and being worried about inflation, this is essentially bad for the stock market. It's bad for stock market sentiment. And when things are looking bad in the stock market, people look for liquidity. They look for treasury bonds. And so therefore, this bids up the price of treasury bonds and sends yields down, despite the fact that Powell is talking about tightening interest rates. When he's talking about QE, what is he talking about, buying less of? Because QE is when the Fed goes out and buys assets. Well, what's most of what they're buying? U.S. Treasury bonds. And so Powell is talking about reducing his subsidization of the Treasury market, and that made Treasuries more valuable. Just on a basic level, intuitively, you would think, well, gee, if the Fed currently is buying Treasuries, and they're going to say, hey, we're not going to buy Treasuries, as much, or we're not going to put as much money into the Treasury market as we are right now, you would think that all else equal, that would make Treasury yields rise. It would make the price of Treasury bonds fall. And yet the opposite happens. It's the opposite of what you would think QE does. So this is obviously a very complex system. Now, one more thing that I want to say about the bond market is that the bond market performing so well today, and seeing yields falling, seeing a 30-year yield now well below 2%, below 1.8% last time I checked today, would also seem to imply that the bond market does not buy into this idea that inflation isn't transitory. Because when inflation is high, yields should rise. there's an inflation premium baked into bond yields. And so when bond yields are incredibly low like this, you would kind of get the idea from this, unless just unless real Treasury yields are just incredibly negative, like negative 5% or something. You would be left to believe, well, gee, 30-year the 30-year bond is yielding less than 2%. In order for that to happen, there has to be an incredibly low level of inflation. Inflation expectations must be in the toilet. Who would ever accept a measly 1.8% interest rate for 30 years if inflation is in the neighborhood of 4 or 5%? That doesn't seem like a winning trade. And so there's a lot that doesn't make sense here. There's a lot of layers of complexity, and there's a lot of potential answers that may or may not make sense. If there's one thing that I can say that I've learned in my years of sort of ranting about financial markets on this channel part-time, it's that the more I study and the more I follow everything that's going on in financial markets, the less I feel that I understand it. Because as I learn more, the more I'm humbled, and the more I realize that I can't be so certain about anything. The more you examine and study all of this, the more you come to appreciate the complexities of it. And when you appreciate the complexities of the modern financial system, it's hard to look at all of these different moving parts and say with certainty, I fully understand what's going on everywhere at the same time, and I understand how all of these different variables impact one another. I mean, by nature, markets are far too complex for any one person to understand, the entire system. That's the point of prices. Prices, they communicate information, so that people don't actually have to, study and do all these calculations themselves. The market sorts these things out. But when we live in an age of, heavily manipulated markets, in order to understand, where things are going, you can't just look at prices, because prices can deceive you when they're being manipulated. And so you do try and study these things and really understand the logic behind the prices. So for now, all I can say is that we're entering a new era. Powell sounded more hawkish today, and again, I hesitate to use that term. It's a little ridiculous to use the term hawkish in the same breadth as the name Jerome Powell, but by Powell standards, he sounded like a super hawk today. And so this might be the start of a new era for the stock market, at least. Because again, I think that stocks are by far the most dependent on the Fed. The stock market is where Powell's voice really matters. And, of course, I thought it went without saying, but I should point out there was a big sell-off today in stocks. And if that continues going into 2022, as Powell accelerates the taper, which he's threatening to do right now, I think that there is a near certain chance that at some point he rolls all of this back. But by then, perhaps it'll be too late. Back in 2018, 2019, when he rolled all this back, when he originally was unwinding, the everything bubble, this great post-2008 bubble, in my opinion, the last great bubble in American history. I think it will be in hindsight. It was not too late. He was able to roll things back. He stopped quickly enough, and he was able to flip-flop. But will he be able to do that a second time? I don't know. I hope not. I would like to think not. But we'll just have to see. So, with that said, I will see you folks back here tomorrow.